Welcome to the Deep Dive. Today, we're cutting through the noise around a company that's trying to pull off a major pivot.
A really big one.
We're focusing on Compass Minerals, ticker CMP, and the pretty significant volatility we saw after their fiscal Q4 and full year 2025 earnings call.
Right.
This is really for anyone trying to sort the signal from the noise when a management team's confident story meets a very skeptical market.
And that tension is really the key here. You've got this business that's, highly leveraged, exposed to things it can't control, like winter weather, and it's been forced to make some deep structural changes.
So our mission today is to figure out if this turnaround story they presented is the real deal, or if the market was right to, send the stock down 8, even 12% right after the call.
Let's do it.
Okay, so let's start with the financials. On the surface, the top line looked pretty good.
It did, yeah.
Q4 revenue came in at $227.5 million. That actually beat the consensus estimates.
And it was up 9% year over year. A solid number.
For the full fiscal year, total revenue hit $1.244 billion, which is an 11% jump from the year before.
And that's pretty much where the clear-cut good news ends.
Right.
Because while revenue beat, the bottom line still showed a GAAP net loss of $7.2 million in the fourth quarter. So an EPS of negative 17 cents.
And even though the full year loss narrowed a lot, down to about $80 million, which is a huge improvement, investors just seem to look right past it.
They discounted it almost immediately.
Yeah.
Their focus snapped right to the future, and that's what caused all that volatility.
But to understand management side of it, their confidence, you have to look at the cash. The cash performance was pretty incredible.
It's the whole counter narrative.
Full year operating cash flow was $197.7 million. I mean, compare that to just $14.4 million the year before.
It's a staggering leap. And that operating cash, that's the fuel. That's what powered their entire back-to-basics story that the CEO, Ed Dowling, was talking about.
Right. So they used that cash to simplify the cost structure and, stabilize the balance sheet.
Exactly.
The cost-cutting part was aggressive. They had a sizable reduction in their workforce, and maybe more critically, they made that call to exit the Fortress fire-retardant business. How significant was that move?
Oh, it's hugely significant because it's a permanent structural fix. That business was just losing money.
Right.
So getting rid of it, plus the other cuts, drove about a $25 million reduction in their SG&A costs. That's an 18% cut year over year. This isn't just a temporary freeze. It's about making the company leaner for the long haul.
And then they took that cash and went after the debt profile.
A big focus. They cut their net total debt by $125 million, or about 14%.
And they also did that big refinancing mid-year.
That was probably the most crucial move on the balance sheet. It pushed their debt maturity wall way out to 2030.
So it takes away that near-term risk.
It completely eliminates that near-term liquidity risk that was hanging over them. And it brought their net leverage down to 3.9 times adjusted EBITDA for the year.
Okay, but let's pause on that. Pushing the maturity out to 2030 is a clear win. It buys them a lot of time.
For sure.
But net leverage is still sitting there near 4 times. For a business this cyclical, that's so dependent on the weather, doesn't that still make you kind of nervous? Did they solve the problem or just kick the risk down the road?
And that is the core conflict. That's what the market is wrestling with. That high leverage means they have to execute flawlessly. There's just no cushion for error. The refinancing bought them time, but to solve the leverage problem, they need sustained earnings growth. And that's exactly why the market cared so much more about their future guidance than their past fixes.
Okay, before we get to guidance, let's touch on the salt segment's inventory problem. They spent a lot of 2024 cutting production just to work through all that excess inventory.
Right, from the prior mild winters.
What kind of financial pain did that cause?
It was a temporary margin drag.
Oh.
A planned sacrifice, really. When you slow down your mines, like Goderich, your fixed costs get spread over fewer tons. So the inventory you sell has a higher cost.
And that flows through to the bottom line?
Exactly. It temporarily pushed the EBITDA per ton in the salt segment down by about 18% to around $20.
And now management is saying that pain is over. They're ramping production back up at Goderich and Cote Blanche.
That's the plan. Restoring production is vital. It lets them absorb those fixed costs over a much larger volume. If they pull that off, the cost per ton should drop quite a bit in fiscal 26, and that's a key part of their guidance.
We should also mention the plant nutrition segment, PIPN, because that's usually been a bit volatile too.
It has, but the turnaround there was impressive. It provided a much-needed tailwind.
Yeah.
Adjusted EBITDA for that segment almost doubled to nearly $35 million. That was on a 19% jump in sales volumes.
So what changed?
They made some big operational improvements at their Ogden Complex. They basically restored the health of their solar evaporation ponds, which made them much more efficient.
Okay, so let's shift gears now. Let's talk about the 2026 outlook. This is where the story clashed with the stock price.
This is the disconnect. Here's the number that matters. Consolidated fiscal 26 adjusted EBITDA guidance is $200 to $240 million.
Okay, and for context, they just did about $199 million in fiscal 25.
Exactly. So at the low end, that's flat growth. The high end, it's only modest growth. For a company with this much debt that just did a massive cleanup, the market wanted to see a clear upward trajectory. Flat is, it's a disappointment.
And that's compounded by the fact that they're spending more money. The CapEx is going up.
Substantially. It's going from about $70 million up to between $90 and $110 million.
And where's that money going?
It's necessary stuff. Maintenance, upgrades, a new dryer at the Ogden plant, and, this is the big one, the Goderich mill redesign.
Right, they decided to build a whole new mill instead of moving the old one. That's a bigger upfront check to write.
It is. It signals they're committed to long-term efficiency, building a modern operation from scratch. But in the near term, that higher CapEx is a drag on the free cash flow they desperately need to pay down debt.
Let's dig into the segment guidance, especially salt. EBITDA is forecast to be pretty healthy, $225 to $255 million.
Driven by better costs and pricing, yep.
But sales volumes are forecast to decline by about 8%, and that's the number that really had analysts scratching their heads.
Management had to jump on that one immediately. They stress this is not a structural demand problem.
So what is it then?
It's a deliberate de-risking of their planning. They're basically saying, we're not going to assume last winter's slightly stronger weather repeats. They're going back to conservative, typical winter assumptions.
So planning for an average amount of snow, not a lot of snow.
Exactly, which sounds prudent, but it leads to that lower volume forecast. And then you look at plant nutrition, and his guidance is also flat, also based on lower expected sales volumes.
So how do they get to flat earnings with lower volume?
It all hinges on getting higher prices and more cost improvements.
Yeah.
So it raises this legitimate question, right? If your operational fixes are so great, why isn't profitability in both segments guided higher?
And I imagine the other big question from analysts was about cash flow sustainability.
Oh, yeah. They wanted to know if that huge cash benefit they got in 25 from drawing down all that inventory, if that was repeatable.
And the answer was no?
Management was clear. It is not. They are not planning on building inventory back up. So that massive working capital tailwind from last year is gone.
Which means future debt reduction has to come from operating income.
Which, as we just established, is guided to be flat.
And that slows down the whole deleveraging timeline.
That's the whole story.
Okay, so let's crystallize this. You have a company that did a successful cleanup, but the market punished them. What are the three big risk factors that outweighed all that good news?
The market's focus is pretty clear. First is just leverage versus growth. Net leverage is almost 4 times. With flat EBITDA guidance, you're not paying down that debt quickly through earnings alone. The turnaround is just too slow for investors.
Your runway is longer than they hoped.
Much longer. Second, and this is the perpetual elephant in the room for CMP, is weather risk.
Right.
Their entire guide is built on typical winter assumptions. Any mild winter and that flat EBITDA forecast is in serious jeopardy. It is the single biggest variable.
And third?
Execution risk. They've proven they can cut costs, which is great. But now they have to deliver on these huge capital projects like the new Goderich mill without delays or going over budget. The market needs to see proof that back to basics can turn into predictable profits. And with leverage at 3.9 times, the clock is ticking.
This brings us perfectly to our thought experiment section. This is not financial advice. We have this deeply leveraged cyclical company whose fate really hinges on Mother Nature. How would you structure a trade around this kind of binary outcome?
The thesis here is pretty simple. The stock has already priced in the disappointment of a typical winter and that flat guidance.
So the downside is somewhat limited.
It seems to be, unless the weather's just a total bust. The upside, though, from a really severe winter is explosive because of that financial leverage. The company is basically a leveraged weather derivative.
A compelling setup. So how do you structure the trade? How do you bet on that extremism but still protect yourself?
I'd pitch the snowpocalypse snowmass straddle, or maybe a collar. You start with a protective bearish position. You could sell some near-dated short calls or buy some short-dated puts.
All right.
That gives you cover if the weather's just average or mild, and the leverage concerns keep the stock drifting lower.
And then the high upside part of the bet.
At the same time, you buy cheap, long-dated, out-of-the-money calls, say 18 months out. So you capture the full potential of the next big winter season.
So if it's a mild winter, your short-term bearish trade helps offset the loss on the calls.
Exactly. But if the U.S. and Canada get hit with a truly severe multi-season winter, a snowpocalypse, the salt segment would just turn into a cash machine.
The volume and price would spike.
Massively. And that gusher of cash would rapidly deleverage the company, launching the stock way past where anyone thinks it can go, and those long-dated calls become incredibly profitable. It's a pure risk-mitigated bet on weather extremism.
A fascinating way to look at how micro factors in corporate finance can create these kinds of opportunities. So to wrap up, what's the one thing people should be watching if they're following this story?
Look, Compass Minerals is structurally healthier, no doubt. They solve the inventory issue, they push the debt cliff away, but the stock is going to stay volatile. The key thing to watch is the execution on those big capital projects. If they can actually deliver that lower per ton cost in the salt business, the leverage becomes much more manageable.
So you need to see the proof in the quarterly reports that those costs are actually coming down.
You do. The company has bought itself time and efficiency, but the turnaround needs that execution, plus something they can't control. A decent amount of snow.
The ultimate lesson here seems to be that in these cyclical businesses, a good structure buys you time. But at the end of the day, Mother Nature often dictates the speed of your recovery. We'd encourage you to watch how those quarterly reports confirm cost improvements versus just hoping for good weather. Thank you for diving deep with us.